Hello, everyone, and welcome back to Defense One's Outlook 2022. I'm Marcus Weisgerber with Defense One, and it's my pleasure to welcome you to our next panel discussion, The Wall Street View. But before we get started with the session, I have one quick housekeeping note for our audience. On the right-hand side of your screen, you will see the main stage chat function. This is where you can interact with your fellow attendees. So during today's session, we're going to discuss and debate a myriad of factors affecting the aerospace and defense market, to include the supply chain crisis, the defense budget, and workforce issues, just to name a few. But let me take a quick moment to introduce our two panelists. First, we have Christine Liwag, who is the head of aerospace and defense equity research at Morgan Stanley. Previously, she spent more than a decade at the Bank of America Merrill Lynch, where she worked with our next panelist, Ronald Epstein. Ron began his career as an engineer at Boeing and has spent the past 2 decades at Bank of America Merrill Lynch, covering U.S. and global aerospace and defense and international industrial companies. Christine and Ron, thank you so much for joining us today. So I'm going to have a little bit of a scene setter here. We have the coronavirus pandemic that has wreaked havoc on global supply chains. There's a microchip shortage, and it's taking longer to get raw materials for companies. For the Pentagon, this means their weapons are being delivered later, and the costs could rise. Another factor that's likely to prompt increased cost is inflation. There's a real possibility that Congress doesn't approve a full year budget this year, meaning the Pentagon will be forced to operate under a continuing resolution. And oh, by the way, the US is increasingly in competition every day with China. So let's just start off first. Ron, I guess I'll throw this to you first, and then Christine, you weigh in after him. How much are supply chain issues hurting defense companies right now compared to, say, consumer companies? And how are aerospace and defense companies managing these types of issues? Again, Ron, over to you.
Yeah, so aerospace and defense, they're not immune from what we've seen in other industries. And the supply chain woes have kind of gone across, the S&P 500, if you will, and they've hit industrials reasonably hard. This last quarter, specifically for the defense companies, we saw some of the impacts of supply chain woes. To put some of this in perspective, if you're shipping landing gear, say from a facility in the US to Toulouse, France, if you did it by sea, which is how you would normally do it, before the pandemic, before the supply chain woes, that would maybe cost you $2,000. If you're shipping it by sea today, it's $20,000. You can ship by air for $24,000. So to give a perspective, that's just shipping something from point A to point B just across the Atlantic, a relatively simple task. So we're seeing it in terms of shipping, we're seeing it in terms of labor, we're seeing it in terms of microelectronics, microprocessors. So the defense industry isn't immune from it, and the commercial aerospace industry isn't immune from it. I would say this, however, commercial aerospace hasn't been hit by it too hard yet because the volumes in commercial aerospace are still very depressed compared to where they were before the pandemic. But one of the things we're expecting, in particular, as we go into next year, you're going to start to see lead times on components, lead times at maintenance, repair, and overhaul shops really stretch out. So that's going to become an impact.
Christine, how about you?
I agree with Ron. These are the things that are affecting the global supply chain. And for commercial aerospace, what we've seen is with the grounding of the MAX previously, and just the recent approval of the 737 MAX this week by China, there's a lot of inventory in aerospace. So we haven't seen exactly what shortage we'll have in that sector until we start seeing production rates go up. But for the defense names, we saw some of that this quarter. LHX mentioned that they had chip shortage, and then both Northrop and Lockheed alluded to labor shortages that led to lower revenues in the quarter. So these are things that the entire industry is experiencing, and the sector is not immune.
Do either of you see these supply chain issues, which the pandemic has certainly, exacerbated and shined a light on, leading to the reshoring of any type of critical components, the raw materials, or even types of rare earths?
So maybe I'll jump in first on that one. Reshoring in general is something that was gaining momentum before the pandemic, and then through the pandemic across different areas, it got even more momentum. On most fronts, if you think about the aerospace industry and the defense industry, it's largely a domestic footprint for the US or for Europe. There's some componentry, particular electronics, we can talk about that comes out of Asia, Taiwan in particular. But if you look at the aerospace exports out of China to the US or to Europe, it's actually pretty small. The piece that's most important is the microelectronics, truly. And we're starting to see a movement of, the Biden administration is pushed forward, making investments in moving some foundries back domestically. That being said, however, A, it takes time to build foundries. B, they're very expensive. And C, most importantly, if you're building foundries and you're not assuring the raw materials you need, like you brought up, namely rare earth metals, it's like building a bunch of restaurants and not having food. So you can build a whole chain of McDonald's, and if you don't have access to beef, what good does it do you, right? So it's an issue. It's an issue that became in, and again, much more extreme focus during the pandemic, and it's something to watch.
And something I'd add there is for microelectronics, it used to be that decades ago, the cutting edge technologies really developed by the US military. But as we've seen the advancement of commercial semiconductors and commercial microchips, a lot of these are now commercial off the shelf. And you're not just reliant on existing defense, the defense industrial base to provide these. You're really reliant on the commercial semiconductor industry to be able to get the parts you want. And if they're domiciled elsewhere, like Taiwan, you just have less control over that supplier. And on rare earth metals, I mean, the DoD imports something like 80% of their rare earth metals needs directly from China. That's a fairly large exposure. And there are only a handful of companies in the US that have access to some rare earth metal sites. And in order to be able to fulfill all that we need, I mean, I was just looking at some numbers here. I mean, one F-35 needs something like 920 pounds of rare earth metals. And a Virginia-class submarine has like 9,200 pounds of rare earth metals. So to Ron's point, if you don't have any food, what's the point of a restaurant? Like, I can't hear of any other better explanation than that.
Do either of you have any, back of the envelope type estimate on what it would take to do this, just both in terms of time and money? I mean, this certainly seems like it's more than, I'm thinking to the, like at the beginning of the pandemic, obviously masks, N95 masks were the shortage. And, nowadays I can go on Amazon and buy an N95 mask or go on another website and pretty much get an N95 mask whenever I want. This is obviously a lot more than just buying a mask. Are we talking decades, billions, trillions of dollars?
Let me jump in first on this one. What gets difficult about the rare earths are, A, they're not that rare, right? B, you just need access to where they are. C, and this is a tricky one, and this is probably an interesting segue for some work that Christine's done. Mining rare earths isn't a very environmentally friendly thing to do. So part of the reason rare earths are rare in the US is because of the environmental impact that you have. It's just kind of basic strip mining. You're just ripping open the earth to get these things. A lot of it's done in Africa. A lot of it's done in parts of Africa that are strongly influenced by China. So it's not just, it's a bigger policy issue than just getting access to rare earths. So yeah, Christine?
I mean, 100% echo what Ron said on that, on rare earths. And then on semiconductors, I mean, the Biden administration before was talking about a $50 billion investment to support domestic semiconductor industry. And, the industry, for the most part, said, okay, it's not terribly exciting. I mean, dollars wise, we're thinking about big factories where you're churning out millions and millions of these things per year. When you think about taxes, labor, inflation in the US, does it make sense to move all of this in the US, and will the government subsidize it for how long and for how much? I think a lot of that is clear, but from that $50 billion type of response from the industry, it seems like it's going to take a lot more than that to really reshore this sector.
Mm-hmm. Sticking with COVID for a moment.
And one point,
oh, go ahead.
One point I would add. Yes, we add one point. One point I would add is, and I think this is when you think about microelectronics, this is an important point. The defense industry is just a small user, right? Most microelectronics are used in other industries. So if you were to look at the microelectronics used in the automotive industry and compare that to what defense uses, defense is sort of a bespoke small user. So from a commercial standpoint, it really makes no sense to stand up a fab just for the defense industry. The defense industry has to be a kind of add-on, a carve-out of a broader commercial strategy.
Got it. Sticking with COVID for a moment, aside from, office workers, and this is not unique to the defense industry, this is unique to all of us, I'd say, these days, as I sit in my basement right now. For many workers being able to work from home, do you see the pandemic driving any other types of institutional changes that are unique to aerospace and defense firms? Christine, go ahead.
I think it has to do with labor, because when you think about aerospace and defense, it's a technical industry, right? Either your airplane will fly or it won't. If you think about completing a complex machine project at home and all the team members are in disparate places, you have to think about the loss of training, the loss of technical knowledge. And even if you apply that in a smaller team, I hired 3 new people this year, and teaching remote was really difficult. And when we started going back in person, and we're in person about 3 to 4 days per week, the learning curve increased a lot. So I think when you're looking at dealing with hands-on physical components and that need to reach certain capabilities, I don't think working remote forever would necessarily solve that. You might lose knowledge just by being around each other. So I think for COVID, if this lasts longer than we expect, we might see some loss of talent, and we might not see that transfer of knowledge that could be really difficult for the industry to innovate in the long run and stay competitive. So I think about that in terms of work from home versus in person, and then also what's kind of a broader policy to get people back in person.
Ron, any thoughts?
And then what I might add to that is, so if you look at what Raytheon Technologies has already announced, right? Raytheon Technologies over a period of years wants to reduce their footprint by about 25%. So that's feathering into their broader labor strategy, just a smaller footprint. I would imagine you'll start to see that across other companies. And how do you do a blended strategy? How do you make that work? To Christine's point, with factory workers, and then in the shorter term, and I think this has been very important, the shortages of labor because of the pandemic. That's been an issue too. So I don't, this still fully hasn't played out. So we'll see how it all plays out. But from a labor perspective and from a workforce perspective, we're in the process of going through something now that's pushing 2 years. That's a very long time, right? I mean, 2 years, things can really change in 2 years. It wasn't 2 weeks, it wasn't 2 months, it wasn't 2 quarters. So I think it would be almost naive to think that the workforce isn't going to change in that 2-year period.
Does the new Omicron variant change your outlook for the aerospace recovery? So much of the defense industry is tied to aerospace work, and with commercial aerospace being so hampered by the pandemic over the last a year and a half, 2 years almost. Does the new variant change it, or does it just kind of maybe slow it a bit?
So our view on the recovery is that you'll get back to 2019 levels of air traffic at some point in 2023. And then you'll get back to 2019 levels on an annualized basis, or maybe better, by 2024. That factored in more variants, right? So what's gone on, more recently with the Omicron variant isn't new. We expected it. The recovery isn't going to be kind of straight up to the right. It's going to be bouncy. It's going to be choppy, and we're seeing that. It's the broader process of the pandemic transforming into something more endemic. And it's just not going to be a smooth transition from pandemic to endemic. I think the hope is, and a realistic view is that as more therapies come out and so on and so forth, and we learn how to work with the virus, we're going to be living with the virus. That's clear. That we'll know how we'll figure out how to travel, live, do everything safely, and that's just going to take some time.
And what I like to that is, looking at demand. There's demand of people wanting to travel, and then there's also government policy. Because if you look at U.S. domestic travel, there were points the week of 4th of July this year when air traffic for U.S. domestic travel actually exceeded pre-COVID levels for certain days in July. So demand's there. And how did demand get there? And we have to think about earlier in the pandemic, we had flight restrictions. Then after that, if you left the tri-state area of New York, New Jersey, Connecticut, you had to quarantine for 14 days. But you've got these requirements, and as in the US, these policies converged, and we actually have a comprehensive US policy in terms of either a federal mask mandate or no quarantine restrictions. Air traffic really came back. Right. So I think for the COVID recovery, and we saw that with even the Delta variant, now with Omicron, I think demand's there. And for the most part, people are going to restaurants, kids are going to school. And so this normalization path is really here. And we'll see what other variants are. And actually, I happen to be in the same view as Ron. My view is 2023 4Q would be when we get to the run rate of pre-COVID levels. 2024 is the first full year of recovery. And then what we really need to see, though, is international traffic come back. Because pre-COVID, it's 1/3 domestic, 2/3 international. And for domestic right now, we're back about 80%. And the two biggest domestic markets are the US and China. But international is still really sluggish. I mean, they're down 80%. Your net number, basically where we are today, is we're tracking to 38% of pre-COVID levels. We've got a long way to go. But I think if that international policy starts converging in terms of, some countries require you to quarantine for, 14 days, some for 20 or longer. Some are just completely shut down. After leaving BAML last year to join Morgan Stanley, I had a garden leave and I got stuck in Peru because they just shut the border overnight. That doesn't encourage international travel if you're not sure how governments will react to additional variants. But I think if we have a more global, if that develops and we have a global course, I wouldn't be surprised if that international component really recovers quickly because demand's there.
As somebody who just traveled between New York and Chicago over Thanksgiving, I can tell you the flights I were on, and it looked like the many other people were on, were very, very full. However, I think we were staying in a space where we were near the approach to O'Hare, and there were far fewer wide-body planes landing aside from cargo than there were, those narrow 737s, A320s, and such. Sticking now just a little bit more with the pandemic, inflation is up. We're seeing it on everything we buy as we purchase, holiday presents and whatnot right now. Who is most exposed in the A&D sector right now, and should defense investors be concerned about this? Maybe start with Ron.
Yeah. So if you think about it from a defense perspective, you can have mistimings in terms of cost with the defense contractor, but largely the inflation's going to pass through both on labor and on raw materials. Now, if depending on the timing of contracts, the timing of when the inflation kind of hits your cost base, there might be a timing mismatch, but you can pass it through. Where it becomes more problematic is in commercial aerospace. For the large commercial OEMs, they do have inflationary clauses that can cover raw materials, but largely they don't cover labor. So if you start to see labor inflation kind of float up through the commercial supply chain, which I would expect you will, that could become more problematic, at least from a profitability perspective, for the large commercial OEMs. What we're expecting to see is, and you're already seeing it, lead times on raw materials, key raw materials, are starting to stretch out. Lead times for maintenance on aircraft engines are stretching out. As we go into next year, I'm expecting to see that continue, and you could see upwards of high single-digit or even low double-digit price inflation on aircraft parts. Now, if you're servicing an F-35, that will kind of flow through to the government, and that's got to be dealt with in the budgetary process. But if you're on the commercial side, not so much. So I don't worry about it so much for defense contractors, but I do worry about it a lot more on the commercial side.
Right. You'd see, I would presume contractors with fixed price contracts, you've Boeing with the KC-46 tanker, which has had its share of problems over the year. A fixed price contract, I suspect, would be more, would there be more of an impact there than there would, as you mentioned, this cost plus type contracts where the government will pick up the bill at the end of the day?
There would be on a fixed price contract, but even on a fixed price contract, I would imagine, let's use tanker as an example, Boeing will go back to the Air Force and say, hey, our labor costs are going up, these costs are going up. And it would be difficult for me to imagine that the Air Force is going to say, no, Boeing, you got to eat the inflation. I would imagine that would be a point of negotiation that would probably go in Boeing's favor. Largely because, to be fair, DoD is a fair customer. I think they understand that, and their budgets are going to reflect some concession for inflation, and there will be some willingness to pass it on, even on something like tanker that's been a problematic program in many ways. That's a different discussion when you're negotiating with an airline who's a customer and they have a stretched balance sheet. They're focusing on costs. They have their labor issue. They're dealing with a much more constrained financial situation. But that gets back. The point is, you could have a timing difference there. Yeah, could Boeing feel it in 1 year or 1 quarter until they get a chance to go back and renegotiate things. So again, it's I think that's a timing mismatch as opposed to just a real meaningful problem.
Right. I suspect though, if this does happen, if the government is picking up the bill, then we might in turn see quantities for the number of tankers or F-35s or you name it in buys become reduced in order to unless Congress is just printing money essentially for to make up for the inflation difference.
Well, they have been printing money. I mean, quite literally. But to think about it this way, right? So the budget for fiscal 23, the starting point, will have an inflationary markup in it that fiscal 22 didn't have, right? So some degree, the starting point in the budget is going to have some inflation already built in. But you're right. So if we get into a situation, and I'm not saying this is the case, right? I want to be clear about that. I want to say B of A is calling for all this inflation. But in a scenario where we did have an extended period of very high inflation, you have a choice. You either put more in the budget or you buy less, if that were to happen. Yeah.
And I'd say, for the putting money in the budget, it looks like from the bills that are being proposed, it seems like deficit hawks are nowhere to be found. So it seems like the probability in terms of just plussing up the budget is more likely than, cutting equipment volumes in this point. But my main concern is really the smaller suppliers, the mom and pops that are, 100 employees or less. I was at an industry conference a few weeks ago, and that was one of the concerns. They signed some fixed price contracts, particularly with aerospace customers. And they're like, look, we have no volume. 737 MAX volumes are very low. 787 volumes are also very low. And if I have to eat all this inflation, I'm going to go out of business, right? So I think, and they have negotiating power to go back to the customer. But I think if the large companies are not as proactive with making sure that their suppliers can withstand higher inflation costs, what you might see are some of those companies just shut their doors And when we're at a higher rate for commercial aerospace, we'll find that, oh, look, we've got a shortage of this one particular part because we don't have as many suppliers as we thought. So that's really where the concern is, because for the large guys, they have enough wherewithal to be able to come back to the customer, renegotiate prices, and have visibility, and also the negotiating power and economies of scale for some of their suppliers to share some of the burden. But really, that small mom and pop that's in the small business arena, that's where I worry in terms of bottlenecks.
I'm glad you brought up the small businesses and the mom and pop shops. I've reported a bit about the accelerated payments the Pentagon has done by paying contractors more money upfront now when they're awarding contracts. And in my discussions with a handful of small suppliers on projects like the F-35, they have said these payments, these accelerated payments that Lockheed in this case or whoever the prime is at the time flows down to them has been very, very helpful in them keeping people employed mostly. Are you hearing lots of the same? I know there's questions right now. The Biden administration hasn't definitively said we're going to keep this policy around. For how long we're going to keep this policy around. People like Jim Takelet, the Lockheed CEO, is told me directly, I'd like to see this institutionalized. What are you hearing from those mom and pops, Christine?
Sure. I mean, for them, defense is actually a great place to be. So if you're an aerospace and defense supplier with aerospace volumes where they are pretty low, defense is a place to be, and also they're paying the bills with defense suppliers. What we heard from Lockheed in their earnings call is that their free cash flow guidance for next year doesn't really assume that some of those advanced supplier payments reverse. And so it seems like there's an effort there to really keep their suppliers alive. And you're seeing also some of these companies pivot a little bit more for defense because they're seeing some growth. We saw a $25 billion plus up in the budget last year. And then it looks like the upcoming budget, would not be the deep cuts that people expected last year. So defense is incrementally an attractive industry to be in today than people perceived it would be maybe 2 years ago or a year and a half ago. So, but that said, it's too early to say how that's going to play out. But it's something that we're watching, right? Because if we really want to get to the higher volumes of the 737 back to the 40s per month, or even 50s at some point, we have to see the entire supply chain get back to the balanced stance that they had pre-COVID and pre-MAX grounding.
That's actually a great point of transition because to talk about the budget, because, I remember in early 2015, then Defense Secretary Chuck Hagel saying, the budget uncertainty was the greatest threat facing the Pentagon. So I guess it should come as no surprise whatsoever. Here we are, just about 7 years later, and there's another crisis looming, and there's the possibility of a full year continuing resolution. The government's funded right now through February. From where you sit, does a full year CR matter that much? And I guess in terms of thinking about the Pentagon, when would it matter, Ron?
Yeah, so in the short term, no, right? I mean, we've been living with these things on and off now for probably the better part of a decade. So politically, there's been, they've figured out how to work around them through anomalies or however else. That being said, kind of what you pick up from folks in the industry is that a CR, by the time it works its way through the system, can be disruptive 12 to 18 months later. So it's not optimal. From an investor perspective, however, I think expectations, like Christine alluded to, were that we were going to see a defense budget that was flat and then going to potentially be pretty dramatically cut. That's not happening. So if you're expecting the budget to be flat and there's a CR, which is by definition kind of a flat budget, from an investor perspective, it's not that big a deal. Ultimately, however, this view that would you see a CR that a full year CR maybe because of the politics around it. But then once you get into next year during an election year, I think it's game on for defense spending, right? I mean, you'll get if you have a full year CR this year, somehow the administration's ask has got to kind of make up for that. And then you're kicking a ball to Congress that's got inflation in it, some sort of makeup for the previous year. And then it's an election year. So both sides are going to be very willing to plus up things. So could you get into an environment where your plus ups next year, the plus ups this year kind of made the budget grow something on the order, if it were to go through, maybe 5%. Could you see that again next year and then some? Yeah, maybe you could. So the answer to your question, is it disruptive? Yes, but is it as disruptive as sometimes it's spun? No.
Christine, any thoughts on a CR?
I mean, to Ron's point, we've lived through it. We've lived through sequestration, and it didn't break anything. It made lives really difficult for a lot, but it didn't break anything. So, but I do think that there is, echoing Ron's point on positive upside to the budget. With what we saw with Afghanistan, with an election year next year, I think one of the questions that Democrats have to ask themselves would be, do you want to look weak on defense in an election year and draw attention to that when deficit hawks are not really part of the debate? Nobody's worrying about it on either side. You don't have, a few years ago, the Tea Party really, pounding the table on cutting the deficit. We don't have that today. So in terms of where that incremental pressure is, it's probably more pressure on the upside than downside, especially if they want to pass on some of the social programs that they propose.
So I want to shift gears totally now, and I know we're going to have a really good discussion about this next issue, and it's on environmental, social, and corporate governance, so-called ESG issues. In Europe, many sovereign wealth funds, they don't invest in defense, and this was a fun one to discuss on the prep call we had just a few days ago. Do you guys see that happening at all on our side of the pond with investors? And Christine, let's start with you.
Sure. I mean, so we've done a lot of work on this, and what we've seen is in Europe, a lot of ESG funds actually look at exclusions when it comes to ESG investing. And our proprietary Morgan Stanley survey that's done by our sustainability team in London, what they found is that the most excluded category for investment in an ESG framework is controversial weapons. That's the most excluded. And they're seeing that about 2/3 of European accounts actually follow an exclusionary method from a survey. So that's a pretty meaningful difference. And when you kind of look at AUMs and how that's being affected, that's basically about $9 trillion of assets under management in Europe that can't, if they have an exclusion method, and defense is one of them, that's $9 trillion of available potential capital for the whole pie. That, I mean, not all of them will be allocated to defense, but that's a pretty meaningful part of AUMs. And so what we have to look at is a philosophical difference, right, between Europe and US. And what we've seen is in Europe, this mindset that defense is bad on an ESG framework is more mature because it's easy to exclude, and they've gotten social support for it. In the US, what we're seeing is some funds with European arms who want to institute an ESG framework are actually looking at what they've already done in Europe and thinking, is it applicable here? And that could be an issue for US defense contractors because, I mean, when the Europeans did this, US defense contractors don't really actively attract foreign investors, right? Because they don't want to do the foreign controlled reporting. And so what they're doing over there is fine for them, doesn't really affect us here. But the question is, you've got a generation of millennials who view ESG as a pretty important topic. And it is, popular today to be anti-nuclear weapons, anti-defense. And that rhetoric, if that becomes widely accepted in the US, and we're not there yet, right? In the US, only 20% of the funds have exclusionary approaches versus 2/3 in Europe. And so it's, and also in the US, about 16 trillion of AUMs looking at an integrated approach versus a exclusionary approach. We're different here, but if you get that traction, the only winner of a situation like that would be basically our adversaries, China and Russia, because inevitably, if that gains momentum and it's easy to use something you've already built somewhere and apply it here, they could have, in the long run, that could affect their access to capital, cost of capital, and would probably be just a negative to our ability to invest in next generation technologies, right? So that's something I actually really worry about. And again, you know, we don't know how it's going to play out in the US. I'm just worried that there's momentum in that direction.
Ron, what do you see? Do millennials, in your opinion, do they not want to work for defense companies?
I think it depends, really, right? So I'm sadly many years away from being millennial, right? So it's hard for me to relate with the millennial desires and wants and dreams and visions. That being said, however, I think a lot of it depends on, you know, if you're, for example, you're an engineer, right? If you want to work on interesting things, defense companies are one avenue you can go work on interesting things that fly and fly fast and all that sort of thing. So if you don't want to sit around and code all day per se, and you want to do something different or code, not a game, or you know, you get my point, right? So if you want to go work on some really interesting, very hard, high-tech problems, defense contractors can be a very interesting place to do that. I fundamentally believe you'll always have people who want to do that. I think Christine makes some great points on ESG, and we'll have to see ultimately how it plays out. On the ESG front, what I fall back on is the European investor community is very different than the US investor community. If you look at the returns on ESG investing, ESG, it's not clear, and in some cases it's actually shown, ESG investing doesn't have better returns than non-ESG investing. So you have to be willing to give up some return to make an ESG investment potentially. I don't know if everybody's comfortable to do that. In particular, I don't know in our market if everybody's going to be comfortable to do that. ESG is a important growing asset class. So, you know, it's something that you have to bear in mind. It's there. It's important. So, you know, the work that Christine's done on it and others have done on it is an important thing. We have a whole ESG effort going on here, like many of the big banks do. But my sense is in the US, it just probably won't go as far as it has in Europe. I mean, another framework I like to think about is you look at the phase out of nuclear power in Germany. They phased it all out. Now power prices are really high. Are they regretting that or not? I mean, not that the US has been pro-nuclear power, but it's been kind of a more kind of moderate approach in how we handle it. And I would imagine that's how it's going to play out here. ESG is, if you will, the flavor of the year, the flavor of the month. It's what everybody's talking about. You know, if we come back in a year or two, will it still be that way? We'll see. I don't know. But it's something you definitely need to bear in mind.
Should companies be thinking about, you know, different ways of how they utilize young engineers? I always go back to, I remember watching a special about scaled composites years ago, and, you know, 10, 12 years ago. And, you know, there was an engineer who was, you know, basically lead design, I believe, for Spaceship One or one of the early space vehicles. And then, you know, he previously had worked at Boeing, and he's, you know, he had such a different job, had such a more, you know, more hands-on job. So to, you know, you have all these, you know, eVTOL companies now. You have, there's a lot of, you know, one thing I remember you saying during our prep calls, you have so many more places for young engineers to go, you know, build. If you want to build an airplane now, you know, it's not just, you know, Boeing and, you know, a few others. So do companies need to rethink the way they are using engineers or employing them?
Absolutely, positively, 100%. If you're a young engineer coming out of school today, it's a really exciting, it's an amazing time to do it. You know, my oldest is a freshman mechanical engineer, and when he graduates school in 3 years, he's going to have a whole cornucopia of things he could possibly do. He could go work at a mature company on mature products. He could go work in eVTOL. He could go work in commercial space. He could go work on Earth imagery. He could go work on supersonics. He could work on hypersonics. There's so much cool stuff going on. So if you're one of the old guard, and just as an example, not picking on them, but if you want to bring in engineers to work on a 737, which is a bus, I don't know, a young engineer, they want to work on a 737, or do they want to work at an eVTOL company and take a swing at changing the world now, right? So I think companies have to think very carefully, particularly the old guard, about attracting talent and making what the work that they're doing kind of relevant to the mindset in the world today. So that young engineer graduating university, why am I going to want to go work for Northrop Grumman instead of going to work on this new really cool system? And who knows if the new really cool thing in the end totally pans out? But you got to try. You took a swing at the plate on something that could change the world. And I think different companies have handled it differently. I bring up Northrop because they're one of the ones, in my opinion, that's done a very good job at recruiting talent. They're very thoughtful about it, but they all haven't. But yeah, I think it's a very important consideration for management teams to.
And the thing I'd add is on lifestyle, right? I mean, so even large banks like us, recruiting is more difficult because if you're a bright young person, coming out of school, you have not even just for engineers, but anybody, you could also work for tech companies. It's really difficult to compete for an environment where, okay, you have free snacks, unlimited vacation. You can work from wherever you want because it's all software anyway. And then also, you get paid really well, right? I mean, a lot of these industries, I'd say the old guard, you'd have pensions before and they were guaranteed pension for the rest of your life. Or, if you work for a large investment bank, maybe it's more on compensation, but you have to work, 100-hour weeks. But then now if you can have that compensation offer, that lifestyle offer coming from a competitive industry that's growing and hiring, this problem is going to be persisting for a while. And companies, and not just aerospace and defense companies, but other mature industries need to be innovative in terms of how do you attract talent and convince new hires that your industry and your company are really where they want to be versus, working for Google or Amazon or Apple, and also get, compensated really well with that better lifestyle offer.
I feel like we could continue this conversation for much, much longer, but unfortunately, that's all the time we have left for today. So Christine and Ron, thank you so much for sharing your time and your insights with us today. To our audience, please stay tuned throughout the rest of the day and tomorrow as we bring you more important discussions during the rest of Defense One's Outlook 2022. Thanks for joining.